Nishchal Maheshwari, who's the head of research at Edelweiss Securities, who joins in from Mumbai to talk about the Edelweiss ET Now lead indicator report. Nishchal, given that the May reading this time around is coming at a level of 95, that perhaps confirms that the April reading was a one-off. Do you think we can expect that the reading this time around will consolidate at these levels?
Yes, it looks like basically, and April, as I was telling you earlier, also was a one-off. I think a couple of months back we had looked at the lead indicator, and if you go by the last quarter, the number also, more or less it's coming out to be that the current quarter, the economy seems to have bottomed out, and incrementally we are seeing that some amount of positive indicators are coming in, whether it is cement dispatches, CV sales, or interest rate cuts. I think these all things are going to start showing up in the numbers in the coming months.
Right now, Nishchal, going forward, you've indicated two factors that could upset the lead indicator index. One is a lull in the production of commercial vehicles, and the other is a rise in the repo rate. Now, why do you think the repo rate might rise?
See, these are all possibilities which we have actually put out, saying that in case once again inflation puts its head up, and inflation is definitely a serious issue out there. So maybe in the second half of the current year, inflation runs up once again back to around 9 or double-digit kind of a figure. Then you might see one is obviously a reverse of the policy of the interest rate cuts, and possible increase back to around 8.5 or higher rates.
Sure. So, but Nishchal, do you actually see that happening? Do you believe that inflation could possibly climb back towards the 9% levels?
Don't see as a possibility right now. But if I really look at the WPI basket, there are two components which the government do not have much handle on. One is the imported inflation, and here we include all the oil, the metals and all, which constitutes around 27% of the basket, and there the government doesn't have anything, any handle on, given that it's all internationally driven prices. So if oil heads up, or the other commodities, especially iron ore and all, go up, coal, iron ore and all, you have to be paying a higher price, and that will lead to inflation. The second part is the agriculture side, where we once again seen that the prices are quite a bit high from the January numbers, and there again it's a large basket. Another 33% of the WPI basket is food, and once again a very little handle on part of the government. So I'm saying around 60% of the WPI basket government doesn't really have a very strong handle. So those are the things which can create a problem going ahead, given that we have done very little about the structural issue as far as inflation is concerned.
Nishchal, do you believe that the global environment could deteriorate from here on and upset export growth projections? What numbers are you penciling in for FY13 export growth?
We have looked at around 20% kind of a growth, which is a long-term average for India. And we are quite hopeful, given that the last year was also equally upsetting across the whole globe. I think India was able to achieve 22% kind of a growth. I think around 18 to 20% growth as far as exports is concerned. I think that could be achievable.
Right. Also, Nishchal, the current account deficit for FY12 is expected to come in at slightly above the 4% mark. How do you see the effect of this playing on the rupee, and how worried would you really be about the effect of the declining rupee adding to the pressures on imported inflation?
Very strong reasons out there. Actually, current account deficit is a cause of concern. It's not helping that the FI and the FDI numbers, which especially the FI numbers, which are strong in the first 3 months, actually have started are not as strong, given that there is issues about the GAR and how it's going to get implemented. I think these are all the concerns, or all the issues basically which is putting further pressure on the rupee. Right now we are holding around 52 rupees on an average for the year in the current year FY13 and 50, some improvement happening in FY14. I do not see much downside from these levels, given that the government's comfort level is also not there. And I think around 52 rupees is where the government is going to come and strongly support the rupee. Because obviously everybody is aware of the perils of rupee going down to 54, 55. Not only it creates inflation, but it also disrupts quite a bit of imports as well as business. So I think I believe that government is going to strongly support rupee at around 52, 52 and a half.
And Nischal, as interest rates come off in FY13, do you see the investment cycle reviving, or would you say it's too optimistic to believe that declining interest rates alone will boost the investment cycle?
I think declining interest rate is one of the components to revive the investment cycle, but another important one is bring down the fiscal deficit so that more money is available to the private sector. So I would have liked to see some consolidation of the government's balance sheet out there, and where the fiscal deficit should have come down less than 5%. And right now I think most of the street and our number is around 5.5% on the fiscal deficit. So you are actually crowding out the private sector as far as money is concerned in the system. So we do not see strong revival of the investment cycle, but coming off a very low base of around 2.5%, I believe it will go back to around 6-7% in the current year, but much lower than the long-term average of around 15-16%.
All right, Nischal, thanks very much for coming in on the show and walking us through the reading for the month of May on the Edelweiss ET Now Lead Indicator Index, which has thrown up a reading of 95, still better than the 90 number that we saw for the month of April.